The IRS just released the new tax bracket adjusted to inflation, and millions of people are now going to pay less in taxes on their income earned. In addition, your taxes are going to be even lower because of the increase in the standard deduction, which means lower overall taxes. For investors, you'll be able to report more capital gains at a lower tax rates too. These changes will allow you to put more money in your retirement accounts, HSA, and other tax-deferred accounts. As a licensed CPA and a financial advisor who's gone through these IRS rules and publications, we are diving into something essential for your 2025 financial planning: the IRS tax brackets. With the inflation continuing to affect our daily expenses, the IRS has adjusted the tax brackets for 2025. But what does that mean for you? How will these new brackets impact your taxes? Later in the video, we will discuss some strategies to lower your taxable income, and most importantly, we will discuss a built-in penalty and some misconceptions about tax brackets that most people are not aware of. Hello and welcome back to the channel. My name is Andre Zagmut. I am a CPA and a financial advisor. I am creating these videos because I believe in financial literacy. Unfortunately, it is a topic that's not taught at schools. I mean, you work hard, you pay taxes with no knowledge of how to plan, you try to save money and invest without knowing the rules of the game. My goal is to share my experience working with 7- and 8-figure clients to help you learn how you can charter your path towards financial freedom. Without further ado, let's get started. First off, let's talk about the 2025 tax brackets. The good thing is that the brackets haven't changed from prior years, meaning your income will be taxed at brackets ranging from 10% to 12%, 22%, all the way up to 37%. Many people worry that moving into a higher tax bracket means all their income gets taxed at a higher rate, but that's not how it goes. The U.S. federal income taxes are set up to be progressive, meaning as you make more money, only the extra income gets taxed at a higher rate. Here's a simpler way to look at it. Think of tax brackets as a set of buckets. Each bucket represents a range of income taxed at a certain rate. Only the money that falls into that bucket gets taxed at that bucket's rate. The government decides how big these buckets are and what they tax at, adjusting them each year. So imagine you're filling up these buckets with your taxable income. For example, as a single tax filer, the 10% tax bracket applies to income ranging from $0 to $11,925. Once that bucket is filled up, the remaining income is taxed at 12%, and again, once that 12% bucket is filled up, you move on to the next bucket, which is the 22% for the remaining income that is over $48,476, but below the $103,350, which is the upper limit of that bucket, and so on and so forth. This is where the concept of effective tax rates comes into play. Your effective tax rate, on the other hand, is the average rate you actually pay on your total income, since your income is taxed at different rates as it moves through the brackets. Your effective tax rate will be lower than your highest tax bracket. Let's use a quick example to illustrate this. Say you are a single filer earning $70,000 in 2025. You might think you are in the 22 tax bracket and that all your income is taxed at 22%. But that's not how it works. In this example, the first $14,600 is covered by the standard deduction and it is not taxed. The next $11,925 is taxed at 10%, which is $1,192.50. The next $36,550 is taxed at 12%, which is $4,386. The remaining $6,925 is taxed at 22%, which is $1,523.50. Add that all up, and your tax or your total tax bill is $7,102. your effective tax rate would be approximately 10.15%, not the 22% of your highest bracket. This difference is crucial to understand because it affects how much you actually pay in taxes and how you should plan your finances. What's new in 2025? As mentioned before, the IRS has adjusted tax brackets for 2025 to account for inflation. But don't expect anything dramatic. The changes are a modest 2.8% bump compared to 2024. This adjustment is designed to help taxpayers keep up with inflation, which has thankfully been slowing down. Here's what it means. You'll be able to earn a little bit more before moving into a higher tax bracket. For example, married couple filing jointly will now hit the top tax rate of 37% only if their income is over $751,600. For single filers, that 37% rate kicks in at $626,350. While the thresholds are slightly higher, the 7 tax brackets remain the same: the 10%, the 12%, 22%, 24%, 32%, 35%, and 37%. Your filing status, like single, married filing jointly, or head of household, and taxable income determine which tax bracket you fall into. What's the deal with the marriage penalty? Let's talk about something that tax nerds call the marriage penalty. But don't worry, it's not as scary as it sounds. Here's the gist. A marriage penalty happens when getting married makes your combined tax bill higher than you would stay single and filed separately. This usually affects couples where both partners have similar incomes. At the federal level, the Tax Cuts and Jobs Act, TCJA, of 2017 helped reduce marriage penalties by making most tax brackets for married couples double those for single. But there is one exception, the 37% tax bracket. For single filers, that kicks in at $626,350, but for married couple, it only starts at $751,600. So, if you are a high earner, tying the knot might bump you into a higher tax rate sooner than you would like. It's like the IRS saying, "Congrats on your love, now hand over more cash." Marriage penalties in the states. Here's where it gets tricky. Some states haven't caught up to the federal changes. At the state level, marriage penalties happens when income tax brackets for married couples aren't double those for single filers. This means some couples face a higher effective tax rate just for filing jointly. For example, there are 15 states still have the marriage penalty built into their bracket. If you look at the map over here, the pink color represents states that have a marriage penalty. The blue color represents states that don't have a marriage penalty. The gray color is for states that have no income tax. For example, there are 15 states that have marriage penalty built into their tax bracket. 10 states, like Alabama and Hawaii, avoid the penalty by doubling the brackets for married couple. Some states, like Missouri and Montana, allow married couples to file separately on the same return, which helps minimize penalties. This uneven treatment can be especially tough for business owners who pay taxes through the individual income tax system. Under a marriage penalty, their business income could be taxed at a higher rate just because they are married. I have few clients who are about to get married and wanted me to do a projection for them to see how their taxes will change once they tie the knot. So we've done an analysis, and some people decided not to get married just because they will end up paying more in taxes. My job as a CPA and as an advisor is to help clients understand taxes. I have to remain impartial, and I rarely share my personal opinions because that's not what my clients pay me to do. I wonder what would happen to me if I suggested to my partner not to get married so we can save on taxes. Another important change for 2025 is the increase in the standard deduction, which, by the way, 90% of taxpayers take on their return. The standard deduction is the amount of income that's not subject to tax, which effectively reduces your taxable income. Here's how the standard deduction looks like for 2025. For single filers and married filing separately, the standard deduction is $15,000, up from $14,600 in 2024. For married filing jointly, the standard deduction is $30,000, up from $29,200 in 2024. And for head of household, the standard deduction is $22,500, up from $21,900 in 2024. These increases in the standard deduction mean that more of your income is shielded from taxes, which is another way to reduce your overall tax burden. And because the standard deduction is so high, it makes it difficult to choose to itemize deductions on your return. For people who choose to itemize deductions, such as mortgage interest, medical expenses, charitable donations, and investment interest expense, the total of those deductions must be even higher now for it to be beneficial. You need to weigh these deductions with your CPA to see if it makes sense for you to itemize. Annual exclusion for gifts increased to $19,000 for calendar year 2025, rising from $18,000 for calendar year 2024. This is the maximum you can give away to friends, family members, or anybody, a stranger, without having to file a gift tax return with the IRS. For retirement accounts income threshold, we are still waiting on the IRS to release those figures. So subscribe to the channel to make sure you're getting the updated numbers so you can budget and plan your finances ahead of time. Strategies to reduce your taxes in 2025. Now that you understand the tax brackets and your effective tax rate, let's talk about some strategies you can use to reduce your taxes in 2025. The goal here is to keep as much of your hard-earned money as possible. Number 1. Maximize retirement contributions. One of the most effective ways to reduce your taxable income is by contributing to retirement accounts, like a 401k, traditional IRA, or even a Roth IRA. For 2025, the contribution limits have increased. For the 401k and 403b, the contribution limit is $23,500, up from $23,000 in 2024. IRA contribution limit is $7,000, which remains the same as in 2024. If you are 50 years or older, you can contribute an additional $7,500 to your 401k or 403b, or an extra $1,000 to your IRA. These contributions are deducted from your taxable income, which can lower your overall tax bill. Plus, with the power of compounding, these investments can grow significantly over time, helping you build more secure retirement. Number 2, take advantage of tax credits. Tax credits are another excellent way to reduce your tax bill because they directly reduce the amount of tax you owe, dollar for dollar. Some of the most valuable tax credits include Earned Income Tax Credit, designed to benefit low to moderate income workers. The Earned Income Tax Credit can reduce your tax bill significantly if you qualify. Child Tax Credit. If you have dependents under the age of 17, you could be eligible for up to $2,000 per child in tax credits. Lifetime Learning Credit. If you or a dependent is pursuing higher education, you might qualify for up to $2,000 in tax credits to help offset tuition costs. By making sure you're taking full advantage of these credits, you can reduce your tax bill substantially. Number 3, utilize tax deductions. In addition to standard deduction, there are many other deductions you might be eligible for, depending on your circumstances. Some of these include student loan interest deduction. You can deduct up to $2,500 of interest paid on student loans, depending on your income. Medical expenses deduction. If your medical expenses exceed 7.5% of your adjusted income, you can deduct the amount over that threshold. State and local taxes deduction. You can deduct up to $10,000 in combined state and local income, sales, and property taxes. Deductions reduce your taxable income, which can lower the amount of tax you owe. Number 4, consider a Roth conversion. If you are in a lower tax bracket now, but expect to be in a higher tax bracket in the future, converting a traditional IRA to a Roth IRA could be a smart move. While you will pay the taxes on the conversion now, your money will grow tax-free and you won't have to pay taxes on withdrawals in retirement. This strategy can be particularly beneficial if you anticipate being in a higher tax bracket later in life. Number 5, review your W-4 and adjust withholding. It's a good idea to review your W-4 form at the beginning of each year, especially if you had any major life changes like getting married, having a child, or buying a home. Adjusting your withholding can help ensure you are not overpaying or underpaying your taxes throughout the year. The IRS has an online withholding calculator that can help you determine the right amount to withhold. Understanding the 2025 tax brackets and how they impact your finances is crucial for effective tax planning. By knowing the difference between your tax bracket and your effective tax rate, and by using strategies like maximizing retirement contributions, taking advantage of tax credits and deductions, and possibly converting to a Roth IRA, you can reduce your tax burden and keep more of your hard-earned money. As we head into the end of 2024, it's also essential to stay informed about any tax changes to the tax code and adjust your financial plan accordingly. Remember, proactive tax planning isn't just about minimizing your tax bill, it's about making sure you're prepared for the future and building a solid foundation for your financial goals. If you found this video helpful, give it a thumbs up and don't forget to subscribe to the channel for more tips on tax planning, investing, and building wealth. Thank you for watching, thank you for your support, and I'll see you in the next video.